I've just got to make this video right now because my brain is exploding with information. And as you can see, I'm in the middle of this markup. It was meant to be quite a simple markup just to do a short trade, but got carried away. And at this point, like I'm accelerating with the amount of stuff that I want to note. Like I want to note every tiny little bit of detail in here, which is great, but it's not what I set out to do. I set out to just do a really simple, I call them easy money markups, which should be just one entry, one model, super simple. And the idea is that um, it's just a really easy trade that you don't even have to think about. But there's so much cool information here. And yeah, thought I'd make a quick video just to talk through it because I've been typing it out constantly. But I'm just going to stay on the screen for now. I can go to a clean chart afterwards, but I'm going to talk through what I've actually got here first. So this is on gold. We had this pullback 2 weeks ago, a really aggressive pullback after being extremely bullish. And that got everyone's sentiment thinking, oh, it's really bearish, meaning that's a great time to buy. It didn't quite hit where it literally fell 1 point, less than 1 point short of my entry that I wanted down here, but it then got this beautiful reaction. We have a inefficiency up here that was completely balanced, so there is no longer an inefficiency in this range, meaning, and we put in an intermediate term high. The intermediate term high then sells off, enticing shorts. We print a really long daily wick. Traders are going to see that long wick, we then run up above it, and then trip in a whole bunch of buy stops up here. Now, what was interesting about this is that when we had this big rally, we spent the majority of the day up at these highs consolidating. Anyone who was looking to get long, they're going to see this big pump, this big green candle. They're going to think, cool, this is a great place to move my stop. And they'll put it down below this impulsive rip up. We then aggressively drop down and accumulate below this sell side. And one thing that you'll notice, and this will be a common theme, is that we have this long wick. We close below the midpoint of this wick, meaning it's a manipulation closure. That is a signature of a original consolidation, which the purpose of this particular original consolidation was to engineer liquidity to accumulate. So after enticing longs, trapping longs up here, sells off and accumulates all that sell size. That's why I have this written out as a previous area of accumulation. This is a previous area where we accumulated all the sell side below these lows. We then run back up and squeeze out anyone who was short through here. When we break this high, this is what gives the framework for the bullish bias, is the fact this is an intermediate term high. If we're in a sell program sell, if we're still bearish, this should not get broken. The fact that it does get broken tells us that we are shifting the order flow to bullish order flow to reach for the next level of liquidity, essentially. If there was still an inefficiency above this high, then that would be perfectly fine to rate that and continue lower. But the fact that there was no inefficiency here, and when we rated this high, we failed to hit this buy side, that indicated that that was a intermediate term high market structure shift, which the framework is ITH MSS to deep discount internal range. An observation, I noticed that when this happens, all the time we'll then make a really deep dive into the lows, and I thought we could even possibly get down to this point and reverse back up. But deep dive into the lows and then continue higher. Exactly what happened. I was looking to buy down here and basically chickened out. But the reason why I wanted to buy is because one, we've got previous area of accumulation. We had the intermediate term higher market structure shift to deep discount IRL. So I anticipated a deep retracement and then a continuation higher. And then if you look over here, we have another manipulation closure. This one not with a wick, but with an order block. So from that candle's open, that down closing candle that took out that low, from the open to the low of that candle, midpoint is the mean threshold. We close an hourly candle below the mean threshold and then reverse instantly back up. So that's a manipulation closure and also indicates potential original consolidation, which is a perfect location for that because it's also just below the previous area of accumulation. So we spend a whole bunch of time up there and eventually work our way down to this range and accumulate, rip higher. The reason I got out of this trade was actually partly because on the 4-hour chart, we had long wicks here, and then we had no swing lows on the 4-hour charts, and then a consolidation. So it was beginning to look like the same framework that I've marked out over here with this long wick. It was beginning to look like that, and I started second guessing it. And then when I saw us drop down to this range like this and then close really deep, that's told me, okay, it's looking really bearish. This is probably just going to melt, and we do kind of have relative equal lows down here. So that might just melt through. So I actually took off the my limit order and didn't take that trade anymore. This low only went a few ticks below that, so that's why it kind of threw me off. But it did technically take it out. And something I've noticed on gold is that it only has to go like a fraction of a tick below, and that's good enough for an actual rate on liquidity. So never think that, oh, we only just tapped the low, it has to come back here, because it can easily reverse. But yeah, so that was this side of the charts that I just talked through, and that's what gave me this the bullish bias. One other thing that I'll mention as well, institutional sweep framework is when we have an institutional level, such as 4K, which is right here. We drop down below 4K for the first time in a while, and then since then I'd anticipate us to sweep both sides of 4K. Depending on the asset, it tells you how much it will sweep. On gold, it's unclear exactly what to expect, but at least 50 points is reasonable. And you can see we reached over 100 points below 4K here. But then when we came back up above 4K, we got 20 points above, but we never reached 50 points. Conveniently, at 50 points above, we have this buy side, which is what this framework here would have targeted. And there was enough confidence for us to reach up there. Now, this side of the chart, we have, this was the beginning of it. So obviously I was already interested in long from here and chickened out, and then it rips anyway. But what I noticed was that we have this 1 hour long wick and also a 4 hour long wick, the exact same wick. And we closed below it, but failed to take out the low and then aggressively rally back up. So that's once again is the manipulation closure, indicating a potential original consolidation. Original consolidation doesn't necessarily mean that we come straight back down there, but it indicates the genesis for a market maker framework. So when I see that, I know to look for the rest of the market maker model, which is a original consolidation, a first stage of the model, which involves a short-term low, intermediate term low, and then another short-term low and a break of the high. So that break right there means first stage is now played out. We're then looking for second stage. You can see we have this pullback, quite a deep pullback for second stage, puts in the smart money reversal, and then it starts rolling up. We have a first stage right here with a 15-minute candle pushing in an intermediate term low, rallies up to the highs, and I actually caught this trade. I recognize this real time. I think I actually made a video on it, one of my recent ones, about second stage of second stage. You're anticipating a partial drop into the range and a very aggressive reaction out. And because this is second stage of this market maker model, just change that real quick. So this is a market maker model, original consolidation here, and then smart money reversal, first stage, second stage, but is within this larger high time frame market maker model framework, which is original consolidation, first stage, second stage. We have now aligned first stage and second stage together, and it becomes a beautiful rip into the highs. The reason I talk through that is because we have the same thing happening over here, and I'll talk through that now. So at this point here, we've had this framework play out from a consolidation, first stage, second stage. Right here, it could potentially be a reversal to head all the way back down to the lows. However, this is where you start reading order flow to get an idea of whether that's the case or not. We sell off, leave relative equal lows down here, but do take out a bunch of sell sides. Then we put in a higher low, and you'll notice here, this is another key order flow thing. We fail to reach the midpoint of the wick. That's a sign of bullishness, and then we leave a fair value gap, displacing higher. So that's a long wick plus gap, which is the antithesis of this model right here, which is my main framework for taking this long today. But long wick plus gap, that indicates that it's a sign of strength. And then obviously you've got trap shorts on whoever was selling down at these lows. We then climb back up to the highs and put in. So this is a smart money reversal. Assuming we're bullish, this is the terminus for this market maker buy program. We then sell off and put in a smart money reversal. We only know that once we know it's reversed. But you can see up here, we put in a short-term low. So smart reversal, low risk buy, short-term low, rallies, comes back down, fails to hit the buy side. So it comes back down, takes out that short-term low. This becomes your intermediate term low, and then it rallies and takes out the high. Now, once it breaks this high before the pullback to put in the first stage, as soon as it breaks that high again, that becomes first stage completed. The same thing over here, intermediate term low, pulls back, breaks that high right there. That is now first stage completed, and you look for second stage, which is what you have here. Exact same thing's happening here. We pull back for first stage. That's essentially that part. Pull back for first stage, put in the intermediate term low. We then rally, and on a very low time frame, you'll find over here there's a short-term low wherever, but any low counts. And then as soon as it breaks the high right there, first stage is now completed, and you can look for second stage. In a market maker buy model, there is always at least 2 stages of reaccumulation, so that you always get a second stage. At this point, we've had first stage, we have hit buy side, yes, but we haven't had second stage. So I didn't like the fact that we had already hit buy side and rejected from it, but what made me quite confident in this long idea was the fact that you can see down here, we'd clearly taken out some significant sell side here. And then on this other time frame, this is the 1 hour time frame, but you can see you can see a swing low, and then the very next candle comes down, wicks out that long wick, and then rejects up really hard. So that's a really strong rejection. It's a long wick that gets souped a second time and then rejects up extremely hard. So that was showing, looks really good. On the daily time frame as well, if you just look at the daily time frame, there are no inefficiencies down here, and just the way that the daily candles print. I don't want to move this off this chart right now. I'm just going to talk through this, but this previous day low down here didn't look like it would get taken out, and um, so that plus the fact that this was a very strong looking area was good. But the main part, as I mentioned, was this long wick. Now, I wrote about it up here. This is one of my frameworks, long wick plus no gap. It's the antithesis to a long wick plus gap. So down here, a long wick, we then get a gap, and it results in a nice move. You'll find that in other places as well. But then in this particular case, we get a really long wick, and then we fail to displace. We just consolidate sideways. And the narrative behind this is that traders typically see a long wick as a bearish rejection in quotation marks. And so they'll see that and be like, okay, cool, that means we're bearish. I can go short. And if people are selling, where are they going to put their stops? Well, above the bearish rejection, most likely. That's the perfect setup for a short squeeze. We have no area within this range for people to trail their stops to on these higher time frames, because people typically will use swing highs and swing lows, which is have a really long wick. And then the fact that these hourly candles down here, they leave smooth highs, that's also supporting this narrative, because traders trading support and resistance will see the smooth highs. They'll want to sell at resistance, and like typically traders won't want to just put their stop loss exactly at this resistance. So for example, if someone's selling here because it's resistance, red and green, they're not going to put their stop loss there and like directly above, because price isn't perfect. It might wick above and then come back down. So they'll look for the next high on the time frame that they're looking at. So these highs will be on the 15-minute, the 5-minute, the 1 hour. On all those time frames, there are no swing highs in this range. So logical area for people to have stops is actually at the high of this bearish rejection, meaning that if we are to start moving in that direction, there's a very high likelihood we'll reach at least up to this high. Yeah, so I actually put in some limit buy orders on Friday at the close, However, I put them below this lower long wick. I figured that we could sell up. We could at the open at 1800 sell off into this range, respect this order block that took out that previous 1 hour candle low, and then rip from there. That's obviously not what happened. However, I was still able to capture it. And in fact, I should quickly. I trade on my personal and also on a paper trading account as well. So I'll put up the paper executions. Do settings, executions. So that's the executions for it at 1800. So that, yeah, this is on Friday. These are all the hourly smooth highs we see in here. Consolidating sideways, leaving heaps of smooth highs. It then sells off enticing shorts. It takes out a bunch of sell side. So it does take out some sell side. We then climb back up and just sit and close down here. 1800 opens up. It takes out a short-term low. Not much sell side though. It only just wicks below that, then rallies. Now, the reason I took this long was one, I had this long wick plus no gap framework. I really like the fact that we had the sentiment going into Friday close was that we printed this long wick, and then that means that over the weekend, everyone who looks at this chart, they're going to think, oh wow, it's so bearish. So the fact that we run up there right at the open, I then noticed that we had this consolidation, and if I just move this box over a bit, you can see from this high down to this low, that's our dealing range. We spend a whole bunch of time within that range. We do not take out the high there. We don't take out the low there, but breaking intermediate term highs and intermediate term lows. So RTL broken, RTH broken, that indicates consolidation. Consolidations, you never reverse from a consolidation, it's always a continuation. However, if you look at this case, we then sell off from here. So that means once we get back above it, you can anticipate that we should get a continuation. But more importantly than that, a consolidation like this, the midpoint should act as a brick wall. And so let's say we have this consolidation, we sell off, you'd expect us to, this point right here, to act as a brick wall. The fact that we closed some 1 minute candles above it here is indicating that it might not be so bearish. But then obviously once we blast through it at 1800, we're clearly not respecting this BPR MT. However, when it fails on one side, you then look for it to support on the other side. So that was the main premise for my entry. Was one, is the second stage of the market maker model. We have the SMR for second stage. First stage, putting in the intermediate term low, short term low to the right of it. We break that high, meaning first stage is now played out. And now we're looking for second stage, so that we aren't expecting a deep retracement. And then on top of that, we have this balanced price range. The midpoint should not get broken. So my exit, as I wrote down here, in validation is a close below the balanced price range mean threshold with no instant rejection. So if we had closed a 1 minute candle below the midpoint of this this balanced price range, I would have demanded the very next candle to instantly rally back up, and then I would have seen that as a manipulation closure, which would be perfectly fine. However, if we were to close below it and then continue pushing lower or close a second candle, that would constitute an exit for this trade. Bought pretty early on, right there. We then rarely make a new high. On my personal, I closed out some partials in here, added back on here, held through this entire pullback, added on some more, and then eventually in this area, I closed out my position before it hit break even. And I'll talk through that in a second. But you can see that we printed a long 15-minute wick here. We then rated it out and rally higher. Here, and then come back down and perfectly respect that mean threshold, get a nice reaction. Now, what was interesting about this is a new 15-minute candle open. So that's 1830 right on that candle there. New 15-minute candle opens, aggressively attacks this previous 15-minute long wick, and then attacks that low. It closes a 5-minute candle at 1834, big down closing candle. That's creating, that's enticing shorts essentially. When you get really large candle closures that then reverse, a lot of the time that's to entice traders on the wrong side of the market. And then we spend a bunch of time at these lows. So by this point right here, this is 1840 We are 10 minutes into this 15-minute candle, so 2/3 of the way in, and we've been consolidating at a discount after this big drop. So big drop entices shorts, we then consolidate down there. This becomes kind of like a last second wick, where in the last 5 minutes of this 15-minute candle, it begins to rally and quite aggressively. So that's indicating bullishness, because if you were bearish, you'd want to see some of these inefficiencies say unfilled. When we rally like that, it shows intent, and that intent is on taking out some form of buy side in the form of trailed stops or just attacking buy side in general. And so I was actually anticipating, I was long right here, and I was anticipating that we're very likely to at least hit this short-term high, because that's on the 1 minute time frame, that's the only short-term high we had. We failed to do so, which kind of threw me off a bit. We start pulling back ahead of the 1845 open, which is a new 15-minute candle, but you'll notice that this happened. This is also a 5-minute candle closure, obviously, and we had 2 entire minutes of creating that wick, which is a decent amount of time, and kind of indicating that, like, it's giving people a chance to see, oh, there's a long wick printing, and this could be a great place to get short. I was looking at the 15-second chart in here, and I noticed we got a short-term high on that candle, very next candle, intermediate term high. And I was looking how we had a impulse low right there on the 15-second chart. We failed to take it out right there, which I noticed, and I was long, had my stop sitting just here, thinking that this was a trap traders down here. We didn't need to return down here. But the fact we had failed to take that out made me extremely cautious. I recognized the intermediate term high, and that this could easily be first stage, and then we get second stage after that, which would be a very aggressive, fast move. So I had my finger on the flatten all button on my personal account. And then on this account, you can see my entry there, and I kept my stop loss down below the balance price range mean threshold, so down here. But I had my, essentially my finger on the flatten all button, and I was watching that low. We got an impulse rejection failure, the same entry as this, but on the 15-second short, and I exited right there at 1849. Very next candle dumps aggressively, would have hit my stop loss, so I saved myself a couple of points. But then it rejects straight back up, which I thought was very interesting. New 5-minute candle opens, drops aggressively, and then gaps up, and then aggressively rallies. So at this point, I'm like, okay, well, that's perfectly fine. Part of the reason why I was being cautious in here and trailing my stop on my personal is because the facts that we hadn't taken sell sides in a major way since the 1800 open. And I figured, well, maybe we're going to trip in these buy sides, like trip in these smooth highs, and then drop down to my original point of interest, which was actually to buy down below this low. So I thought maybe we could do that and then accumulate and then rally. So I was being a little bit cautious. We break that high. Now, if you remember, that's the 15-second intermediate term high, and I've written out here market maker buy model. So intermediate term high sells off, second stage, smart reversal after second stage, and then at this point you can start seeing, oh, we could actually be heading back up. We have this sell-off here at 1853. The very next candle rallies back up and closes back above that 1 minute swing high. Now, this is the impulse rejection failure entry technique, and this works ideally just with second stage of a market maker model, because it only works in a very fast environment. So if you are in a consolidation, very unlikely to find one that's going to work well. But if you can identify a second stage of a market maker model, you can find this entry technique will likely work. And then right here, you can see it working out beautifully. We're in second stage of this fractal from this smart reversal, first stage, second stage. And then in here we are, a bit of consolidation, but in a fractal market maker model just here. We have second stage just afterwards. But essentially, it's once we hit that high, we begin to reject lower. If we were bearish, you'd want to see that continue pushing lower. The impulse rejection failure is when we hit a high that should reject price, but then we closed right back above it on the very next candle, which you can see at the end of this line. There's a dot there. That closure back above, that was the entry signal. You buy, you put your stop below the failure swing low, and that's I took that on my personal account and held that up into this premium fair value gap, as I did with this. With this one, I exited just there as we hit that fair value gap, with 2/3 of the position, and yeah, that one worked out really nicely. I didn't add into position at all through here, but I just left this runner on because obviously that my main target was that high, and was able to hold, yeah, held one up as we approached the high. I took three off at deep premium internal range, so it's just at this level here, and that was based off of this order block. So the most premium PD array I could identify was this opening price right there, of this range, because after that, that is external range, and I always like to take something at deep premium internal, so I took something off there, which was the right thing to do, and then held that runner, and that ran up to where did I take that off? Up here. So that was the idea, was that the same thing basically. That is external range right there. That swing high is the highest you can go. Below that, what's the most premium internal range high? Well, we have, well, or PD array. And in this case, that's that swing high, that impulse high right at a deep premium. And that's where I got out of that one. So I'd say the execution on this was quite nice. Obviously, I got paid a lot more on this demo account than my live account, and that's because I kept my stop loss all the way down here and let it do its job. Um, Honestly, I didn't quite pick up the fact this was second stage after the first stage. Like I kind of I did guess it. I did like look at it and think, oh, this is first stage here, but we already had external range, so I don't know about second stage. But yeah, it was really just the fact we'd already hit buy side that made me less confident on the long. But what really, the thing that locked it in was once we got this push up past the midpoint of this range. So I'm going over a million concepts here, and this isn't supposed to be a straightforward, easy, simple video. This is just because my brain was dumping all this stuff. If I hadn't started making this video, I would have written out, I would have filled out the rest of the space, and I probably still will. But the next concept that I'll just quickly go over, the liquidity mid concept. So this concept is essentially when you have two liquidity pools, you are looking for, we're likely to have a bounce at the midpoint between those two pools. And if I find an example of that, where that happens, we can find, for example, here between this high. So if I draw a line on that high, draw it out to this high here, you're looking for us to respect the midpoint of those pools. We failed to reach it there. I think there's actually a better example. This isn't really all that clean because it's kind of a bearish, bullish environment. I think this was a example. This is the wrong time frame, but on the 15-minute chart, I believe we had this obvious buy side pull here, a clean high, and then it sells off aggressively. The buy side pull below it is this swing high. So we have a swing high here and a swing high down here. There weren't any short-term highs in between. The idea is that we are likely to respect the midpoint, and if we don't respect the midpoint with candle closures, then we will head to the high. If you look at the 15-minute chart, I'm pretty sure on this day it wicks above, but it fails to close above, and then it sells off aggressively. The idea that I've got written up over here is that between this high and this high, there isn't any buy side, so that becomes liquidity mid. And then you're looking to see, okay, do we want to reject from there? Or if we close above, which we do right here on this 15-minute closure, that's indicating bullishness. In fact, it's an hourly closure as well. And if you were to look for longs up here, that could be a supporting factor. So yeah, second stage of second stage, as I mentioned, this is second stage of this model with this one reversal. First stage breaks the high, second stage, and get this beautiful big push. But then this is also a market maker model. This is that after hitting the high, this is the long wick, have that pullback, and now we're looking for second stage. But second stage is its own market maker model framework. We have a smart reversal, short-term low, intermediate term low, putting in first stage, short-term low, breaks that high, meaning that we've now played out first stage, and then you get the second stage. So when you have second stage within second stage, you're not just looking for a little rally like that. You're looking for a much higher time frame model, and that's how you get the best moves in the market. As you align multiple time frames to find the most aggressive, volatile move on multiple time frames. So in this case, we have a high time frame second. Well, this time frame, a high time frame second stage of this model, and then on the low time frame, we have the same thing. We have a market maker buy model, and then we have first stage, and then we look for second stage. And in here, this is where it starts getting insane, is that you can use like each stage has its own framework. For example, this is second stage of this high time frame market maker model framework with a smart reversal, first stage, second stage. Within second stage, there is also a market maker model framework. Okay, well, what about this second stage? Well, you could probably say this is also a market maker model framework. I haven't really done all the work to figure out all this stuff, like exactly where it is, but I can kind of see how this could be the original consolidation of the second stage for its expansion league. So, there's such a brain dump. But the the market moves obviously in market maker model. So you have the classic market maker model, blah blah blah. And then within each leg, you're going to have market maker model framework. So from the original consolidation expansion, you'll get these fractals within those ranges. And I'll just draw out a little example. Oops. I'll draw out a really small example, and then I'll um, explain it real quick. It won't take a minute. So if you imagine this fractal right here, if you imagine this thing right here, that resides when we leave original consolidation before the retracement here. So this thing here is in this box. It's also in this box when we're going from first stage and expanding lower. Okay, and then it's also in this box when we have second stage, and second stage expands lower. So in each leg, we have a fractal market maker model framework, and that's what this is over here. We have a, like we never, this isn't this model right here. This model says, oh, consolidation, smart reversal, and then takes out rigid consolidation. We don't do that here, do we? We have consolidation, expansion, and then intermediate term low, um, for first stage, and then a second stage occurs and rallies. That's an expansion leg. That's this, but upside down, basically. Once that has happened, that is a maker model framework, but it didn't do the other side of the curve. It doesn't have to. And that's where this becomes interesting over here, is because we can identify that we have, okay, we've got first stage expanding into second stage. And if you look at this fractal right here, you can see, okay, we've got a short-term low here. So if this is first stage, and now first stage is expanding into the highs, we have first stage, we have sorry, smart reversal, short term low, intermediate term low, breaks that high, becomes first stage has played out, and as soon as we break that high, we're looking for second stage. It pulls back. We have IOPD for second stage, breaks the high. At this point right here, second stage has played out for first stage, meaning that first stage is now complete. We then have the same thing for second stage, but obviously as you zoom into the fractal, it gets more and more fractal in nature. But at this point, you can do the exact same thing with a smart reversal for second stage, short-term low, intermediate term low, short-term low, breaks the high, second stage, and then rallies into the high. However, now at this point, all the timeframes are beginning to align. You have all these higher time frame. Let me just get rid of all these things. You have all these higher time frame market maker frameworks aligning with this lower time frame one, and now we've just had second stage play out, but now it's aligning with this high time frame. So you're not expecting this second stage just to go up to here, or this second stage of this second stage of this second stage just to have a little rip. You're expecting a larger push. And that's what I meant before by I haven't really looked at this super closely, is because what exactly is this? Is this the original consolidation that I mentioned? If I undo that, this upside down, is this that squiggle there? Is that this original consolidation? Is this the short-term low, intermediate term low for first stage? Rallies, breaks the high. That means first stage is now complete. And now you're looking for second stage in here. And then you see second stage complete, consolidation, first stage here, short-term low, intermediate, breaks the high, second stage. And then at this point, you're like, well, now we're at like it's like, what is it? It's like the movie, I don't know, is it Inception? But it's like it's a fractal. This is a fractal within a fractal within a fractal within a fractal within a fractal. And you could keep on going up, but um, it's like when you can put all these time frames together, you can find these massive moves. And like multiple times, like last week, I found that I saw this one real time. This one, I didn't quite see it real time. Like I was expecting like a push, and I kind of saw it, but I didn't really trust it. But I am beginning to be able to identify this before it even happens. And once I can learn to, because I can do that, once I've actually learnt how I can actually trust that that's what's going to happen, like this could offer some pretty insane opportunities. The time nuance thing that I wrote out here, that's essentially saying that last week I got burnt multiple times, really, really badly, by having a bias at 1800. The market moves my way. I'm like, sweet, this is awesome. I start getting in my trades, it's moving. But then it pauses for a bit, and it pauses for a couple of hours, and it's like 8 p.m. at that point, and I'm still trying to go the same direction. But the whole time we hadn't taken opposing liquidity. And so I figured, and then it reversed on me and took me out. So what I figured was that, well, it makes sense that at 1800 we're going to have a momentum type move. So we are likely to just rip in one direction, and so I should be ready to take those sorts of trades and not worry about, oh, did we take sell side first? But the further into the session we get, the more time we've been just enticing longs, and so the high probability it is for a reversal back down. So that's another reason why I didn't take any entries up in this area. It's because we were now 1.5, 2 hours into the session. We hadn't really had any major attacks on sell side. So even though like I was like, I'm pretty sure we're going to take out this high because we've got trap shorts up here, I wasn't going to add new positions in this area. That's a little rule that I've kind of started implementing and was using today. But that can also give me more opportunity as well, because that can even give me, like, everything in the market has an antithesis. If something doesn't, that should work, doesn't work, it means the opposite is likely to happen. Like, because by definition, if something doesn't work, then it's not going to do the thing you thought it would do. And there's only two directions in the market. There's up and there's down. So the time nuance, basically, I didn't want to take any longs after 1900 because we hadn't really run out some major sell sides. On certain days and certain situations, that could also mean give you the opportunity to look for the opposite. So to look for a short. However, I obviously wasn't dumb enough to take a short today, and that's partly because I was able to recognize a million other of my frameworks and signatures and stuff that indicated we were bullish, which, it's great, but is a kind of a bit of a problem because, as you can see, I've got so much information just flooding my brain, and that it doesn't constitute very effective trading all the time. Like, sure, I can see all this epic stuff, but executing on it is a whole nother thing. especially if I'm doing this. Like if I could have a much more basic, simple model and have not taken any partials here because because I'm just capturing the movements. And that's something I really want to work on, is being able to capitalize on whatever range is being offered. So rather than being like, okay, I'm going to, let's say you just target equal highs. You're like, okay, I'm going to buy here and we hit the equal highs. And so they close the trade right there, done. Now that's sure, that's a logical place to take a partial, but the market hasn't told you that it's done. And I want to develop a profit taking strategy or a standard operating procedure for profit taking, which is going to be different for every different model I have. But I want to develop something that allows me to get into a trade with, so my brain's slowing down a little bit, allows me to put a trade on and have very specific profit taking procedures. For example, with this particular entry, the M1 impulse rejection failure, this one with this framework, essentially what that is, so I'm getting back to what I was just talking about. This framework is when you have a retracement that puts in a reversal. So it's basically a fractal of the market maker model, and it gives like another fractal of where to expect that second stage. And this kind of like overlaps with the other market maker model concept. So you might, if it sounds confusing, it is, but this is probably one of my favorite frameworks right now. You have a retracement. So we put in a smart reversal. We then make a high low. That's our retracement. So we're now looking for first stage. First stage happens when we break that high. So this dashed line represents that. So we've broken that high. And then looking for second stage. So first stage is played out. We then have a pullback. I mark out that high. And then as we break that high, that means that we are in second stage. And what I use for an entry is I look for us to break that high, with the impulse rejection failure, basically break that high, get below it again, deliver some sell side delivery below that high, and then close back above, and that becomes the entry long, which right here, it's hard to tell. I don't even know if you can see on this time frame if we did actually deliver sell side. But let's say we had gone a bit deeper into this range, close below, close back above, and that'd be the entry right there. And then the reason I had to explain that real quick is because this is a profit taking standard operating procedure that I have for this framework. Is once you have that entry, so let's say that's the entry there, you're then looking for two breaks of the high to go to break even. So we have one break here. As we break the high there, that becomes one, and then we have a high here, pullback, breaks the high again, that becomes our break even point. So we then would have our stop loss at break even, and then potentially use let's say a 2-minute trailing stop system or something, and then you could potentially capture whatever momentum exists while being risk free on the trade. I'll see if I can quickly bring that up. Should be able to do it fairly fast. Um, there we go. So this is essentially what it is. We have a retracement that puts in a reversal. So that's this. We have a shift, pullback for first stage, breaks the high again, has the second one there, and then that's your entry. But when we break this high, that becomes our first break. We're then looking for a second break and then go to break even. That would mean that I'm not going, okay, I'm going to get in here. Oh, break this high. That's my profit taking. It's more like, okay, maybe I can take a partial at some logical area. And then I'm waiting to get to break even. And then once I'm at break even, I can then start trailing or something. But essentially, I want a way to capture this movement, but it has to be a very standard operating procedure, something that I do every time, a non-negotiable way of delivering the service of my particular framework. I was doing some journaling in the weekend and doing some brainstorming actually, doing some brainstorming with Grok and ChatGPT, getting their insights. on how I can create a um, basically see my trading like I'm providing a service. I'm providing a service to the market, a very premium service, and that would, yeah, be kind of like a business would, where the market presents a certain setup for me that I specialize in, and I deliver that service exactly to spec. And that would include one, identifying what the a order from the market actually is. So what qualifies as a setup, and that would be whatever, when you can see the framework. Once you've got that, then you're looking for the execution of that. So, okay, well, once we have that order that's not confirmed, how do we execute that? Well, we have a very specific entry criteria and stop loss criteria. And then we have the final one, which is the invoicing. Like, how am I going to invoice the market? How am I going to do the profit taking? And so having a very standard operating procedure of, okay, at 2R, taking this off, or at deep premium internal range, taking a partial, moving to break even at this point here after these two breaks, and then trailing using the M2 stop, and just being very binary about it, and just seeing my trading in a different light, uh, kind of like seeing it like I'm delivering a premium service to the market, and I'm just an expert at delivering this service. And if I'm doing that, if I'm a specialist, then I can charge a hefty premium on my specialist service. And yeah, it's not really my problem where the market gets the money to pay for my service, but as long as it's ready to cough up some money each time it's, ask for my service to be delivered, I'll just deliver my service, and I can't guarantee what the outcome will be for the client, which is the market, but I can guarantee that I will deliver it to spec every single time. That's something I want to work on at the moment. I've started building up a Notion page to kind of record that for myself, but yeah, it's kind of where I'm going because last week was a very rough week. One of the rougher weeks for me, which wasn't very fun, but it is those kind of things, that those kinds of days, those kind of weeks that um, lead to the largest growth, because you're only going to change when you hit a certain pain threshold, and then that's because otherwise you're just going to keep on doing the same things. And I was not trading well last week, and especially going into Friday, like I'd have a high probability trade that I knew was going to go in my direction, and I couldn't hold for more than a point or two. That's how bad my psyche was last week. So yeah, that is essentially this thing. I'm not actually going to go to any clean chart. I've been talking about this long enough that if anyone has actually watched this, or if I want to watch this back, I've had enough time to read every single annotation, and I've explained it all as well. Normally I'd like to, yeah, go through and just mark it all up again, but yeah, I feel like this was pretty well explained. Going forward right now, as for gold, I'm going to quickly just mention this. So, oh, there we go. I've got a nice shortcut to hide. So going forward for gold, you can see that we've had this nice pullback. We failed to reach the 420s up here, which is kind of what I'm anticipating us to hit. I don't really know what we're going to do from here because we've been leaving a lot of smooth lows behind. I do favor bullishness because we are bullish technically, but right now it has just hit my target, which was that inefficiency. So I'm not too worried right now about trying to predict where we go next. I'll just be waiting on gold to see what it wants to do. We did hit some significant sell side, got smooth highs above, and major buy side up here. We're extremely bullish. I would definitely be inclined to think that we continue. Maybe we get a pump up to here and then an aggressive sell off to reaccumulate internally below 4K before ripping higher. Uh, but yeah, no real expectations just yet. Trailed stops will reside below these lows, so it'll be interesting to see what happens if we want to attack those as well. But yeah, that will do for this video, I would say. And there's our beautiful, if I can get it back to where it was. Yeah, there's our markup, and yeah, adios. We'll now jump over to gold because gold is a bit more important right now. I'd actually put an order in on gold just before the close on the weekend, but I'm beginning to think I should change something about that, and I'll talk through why that is. But basically, on the daily, since I'm here, we had that big sell-off, created a bit of a long wick, created relatively lows just above that wick. However, Thursday the 30th of October did just tip below that previous day low, rallied up, big up closing candle. The next day, took out the high, rejected lower, looking really bearish, closed very deep in the range, and then but failed to take out those relatively lows. Then Wednesday, climbed back up and is just sitting at a slight premium of this dealing range. My analysis earlier was that we would take out that previous week high, and price is going in that direction, but the order flow on the daily is definitely not bullish just yet. So yeah, that's the thing. We're in a very balanced range, still within the range, at a slight premium to the range, which is another thing I should be keeping in mind is that if we're in a consolidation, even if we did reverse prior to the consolidation, I still need to reference where that EQ is of the dealing range, and not be buying above EQ. So let's say from the previous week high down to the previous week low, well, not the higher low we created. If we are consolidating, then we are at a premium technically right now. And the reason I got long was mainly just because Friday 11 a.m. closed of a really long 1 hour wick and also 4 hour wick. It did raid buy side. That's the thing. It raided a previous day high. Fell short of some other buy side, but did raid a previous day high. Rejected, closed way back below. But the reason I got long is because we then consolidated sideways for the next 4.5 candles. And we had taken sell side prior to raiding the high. On the daily chart, I decided that we didn't look like we were going to take out the previous day low before hitting buy side, which I was correct about. However, we have hit a form of buy side, not the buy side I was specifically looking for, but we did hit buy side, and now we're pulling back down towards the sell side. I have a limit buy order just below the lows, and price is dropping towards that. But yeah, I really like this framework is the long wick plus no gap. So we've got a long wick that was engineered really obvious, and then we failed to displace low. We did leave smooth highs as well on the 1 hour charts below that long wick, and it looks really set up for a short squeeze. Like I do like that narrative and that setup for the short squeeze. And we did take out sell side as well prior to rating the highs, but the issue is that, as I mentioned, we hit buy side already. So the standard operating procedure for this type of situation is not to buy on the front side of the move. I'm allowed to buy the long for sure, that's fine, but it should be on the back side of the move when the trade is going in my direction. At the moment, I've got limit orders set up just to buy the stoop as it drops into the range. So I'm actually going to cancel one or both of them, and then look for any reason to get long once we drop into that range. So I'll do that now. It is 17:59, so I've got 1 minute to bring up MD5 and get prepared. So it is currently 6:30 p.m. and what ended up happening is 1800 actually ripped straight from the open, straight up to those hourly equal highs, and we tapped into that twice, put in an intermediate term low, and respected the balanced price range mean threshold from that consolidation, making up those relative equal highs. So I've been wanting to see that hold, actually bought just above that mean threshold, caught a nice little run up from there, and expecting us to have a short squeeze up to the highs. But in saying that, we did just trip in buy side, as the only thing we've done today really. It is still only just after 1800, so momentum-based scalps are still valid. We don't have to have taken opposing sell side first. But there's another narrative that I can see forming, which could be quite high probability, and that is if let's say we've just tripped in buy side above these move highs, and then we drop down for that sell side. That would make that soup that I wanted originally a lot higher probability. But I am still holding on to my position long with a stop loss down below that balanced price range mean threshold, and got a target up at around 4,017. There's a 1 minute impulse high up there at around the midpoint of that 1 hour wick. So I figured that could be a good target. But yeah, at the moment, we did get the first 15-minute candle closed right at the high. The very next 15-minute candle sold off without taking the previous 15-minute candle high. So that was that nice squeeze reversal framework. That did take out a 1 minute impulse low, into the 5 minute fair value gap, which is where I added to my position. We then rallied from there, hit a premium 1 minute internal range high, but since then have been rejecting from that high and have not been getting back up to it. We're kind of just pushing down towards the low. So it is looking at the moment like it wants to come back to my entry. If it does, that entry is very near that balanced price range mean threshold, which is in validation. So I'll add to my position there if it taps it. And if we get a closure below the balanced price range mean threshold, if the very next candle wants to absolutely rip back up, then I'll stay in. Otherwise, if it just shows that it wants to keep sinking low, then I'll just cut the trade and take that L. But should still be around break even on the day if that is the case, because I took a bunch of scalps within this tight range. That's probably why I'm holding on to this last position. It was up $10 at one point, which is fairly significant in a $50 account. But then, I kept on taking little scalps. I was like, no, I want to hold this last one. Just trust this trade's thesis, which is that balanced price range will hold, and just see if that wants to go to terminus. If it does come and take me out, that is absolutely no worries, and it just means that there's a high probability that the soup below the PM low would be favorable for a long. At the moment, just holding out and just letting it do its thing. And as mentioned, I've got that limit buy down at the lows to add into the position. And if that breaks, then I have the limit buy that I originally had on over the weekend. And I'll let that one do its thing if we can get that, because that is now high probability that we've tripped in buy side, really obvious sell side down there. So that could be a nice space to get involved. But yeah, that's essentially it. Kind of sucks to see a $10 winner come all the way back to break even. It was only up maybe 1.4R or so at the time. But yeah, I want to train myself to follow the thesis I have and actually let it pay me. I was listening to that podcast with that options trader who was talking about how if you
if you always take partial stop outs, then you're never going to be able to hold on for the big winners. You'll never get to capture the full move. So I want to give it opportunity to move in my direction. I definitely want to also practice kind of what Aaron Trades does with identifying the high time from candle closures, and when he has a certain candle close against him, they'll tell me that get in or get out. I don't know, I've never really traded like that, so it could definitely be something to implement, but I'd have to do my own observation on it. So at the moment, we just had a big 5-minute down closing candle that perfectly stopped at the bounce per range mean threshold. I don't know if that means that I should just get out here or if I should be looking for that traverse back up. But I'm still got about a 70% probability of it working, I'd say, maybe a little bit less, definitely over 60% probability, and we just had some major sell sides of a really obvious low for trailed stops, so I'll see that rally from here, but we'll see in the next couple of minutes if we get that closure below the balance price range mean threshold, and if we get that, I'll give it just a few seconds to show if it wants to have a manipulation closure and reversal type situation, and if it doesn't, then I'll just be exiting there. So big 5-minute down closing candle that took out that what looks to be an intermediate term low at the time, but immediately the next candle we spent an entire minute at 16.35. We spent a minute down at those lows, and now at 16.36 we're beginning to climb back up. So I'd like to see some speed back up to a short-term 15-second high if we can get that. Then I want to see when we hit that high. There's a nice little impulse high just sitting up here at 4,007.34. Once we hit that, I want to see us get through it, and I'll be trailing at least the one that I added on to break even once we hit that high. Because if we are going to reject back low, that would be a key place for it to happen from. But I kind of like the fact we're spending a bit of time down here and then beginning to climb back up. If we can start getting some speed up into these highs, then that is what's going to tell me if we are actually going to continue or not. And if this doesn't work out at all, I'm not going to be looking for shorts or anything. I'm only going to be just waiting for that swoop from the low down there to happen. But getting a nice bit of speed up towards that short-term high at the moment. Just had a 5-second short-term high, but that's not as relevant as the 15-second impulse high to me. So I want to see us get a little bit higher up. So on Friday as well, after printing that long wick on the highs that I'm taking the long into, at the very next 1 hour candle at 12, we printed a long wick down towards the lows. And we've been sitting within that range, but sitting down, consolidating just a bit above that 12 o'clock long wick as well. So to me, that's kind of looking like we might want to stupid out. That's partly why I took the long, put the limit buy longs in on Friday. I actually put it below that swing low because I thought that's a great liquidity pool that if we came down and tapped it, that would be a great opportunity to get long and then catch that framework into the 1 hour long wick plus no gap. So I'm actually going to trail that stop up now, just that most recent ad for that at break even essentially, because now I've only got $2.88 USD on the line, about 5 NZD total, and that's with the trailed stop to break even, plus also my main position, which I'm going to hold until we either get a closure below the balance price range mean threshold or hits my target. And this other one I'm going to manage and just look for that to keep on pushing. That's getting a bit of speed right now, so that's exactly what I want to see. Just hitting that 15-second impulse high. So looking for some speed up into the range. Keeping in mind what happens when we hit the that consolidation high as well. I want to see us tap into it and get above it easily. And if we show any kind of rejection from it, then once we hit that consolidation high, then that could indicate it wants to come back down again. We're just into a 5-minute fair value gap right now. Relatively high resistance. Getting some nice speed up through here, looking really good. Beautiful. So just having that consolidation high right now. I want to see it continue pushing through that. I'm now trailing both stops to break even, and I'm prepared to take one off if we show rejection from that high. But it's showing a lot of strength right now, so that's really good. It's going to have a quick look at the 15-minute charts as well. So 15-minute came down, took out the previous 15-minute candle low, and is currently rejecting back up. We have 3 minutes until this 15-minute candle close. We've consolidated down in the low end of the candle for the first 10 minutes of the candle, and only at kind of 1840 did we start pumping back up towards the highs. So that is looking really good. It's kind of like a last second wick equivalent, where we spend the majority of the time at the lows and then speeding up into the close of that candle, kind of trapping traders at the low. We have not yet had a 1-minute impulse high on this run back up. There is one just above us. So I'd like to see if we can reach up to that. But we did hit the consolidation high. It's dropping down to a 1-minute fair value gap. So I'd like to see if that can continue pushing high from here. That should not come very deep into the range. So I'll trail my stops a little bit further. Now locking in 3 NZD. So that's worst case scenario now is plus 3 NZD. Best case is if we hit those highs up there, which would be a solid win on the small account. But it's looking a little bit aggressive on this drop back down after hitting those impulse highs. We've got 45 seconds left in this 15-minute candle. We hit the high of the 5-minute SIBI candle 2, so that middle candle. Tapped into that and also above that consolidation high, and then fairly aggressive drop straight back down. But what's really going to tell me is on this new 15-minute candle opening, if it wants to pump up into the highs or pump into my stop. So I'm just going to hold out for that, see how we go. The 5-minute did close respecting that SIBI previous 5-minute candle low. And that 15-minute candle did close bearish despite having that long wick that took out as the previous long wick low. If we were to sell off now and take out that long wick, that would be a wick rejection failure. But I do have to first identify what range we're working in, and if I pull out the range from the high down to the low, I suppose down here, it's pretty much bang on at EQ, so honestly it could go either way. If I was to interpret it one way or the other, if we use the internal range low that we made after having hit ERL with the high, and then that pullback that made the low, that's the low we're consolidating within. So on the short-term dealing range, we are at a discount, meaning that we could get the triple wick flip, which is when we have a wick rejection failure, but then we close back above the midpoint of that middle wick, and that could potentially offer a long opportunity as well. Otherwise, because it is kind of in the middle of the range from the low we made on Friday at 10:30 up to that high that hit ERL. It was kind of in the middle. It could also be a wick rejection failure, which would just be a short, which I wouldn't take, obviously. But that would send us down into our point of interest we had prior to this run up. But not a big fan of how it's just sitting here. There is a 15-second impulse low that we're just hovering above as well. When we do hit that, which we're very likely to do, I want to see it reject back up. If it gives me an impulse rejection failure entry signal to the short side, I'll just manually exit the position. So not a big fan how it's just pulling down to that impulse low, falling like a tick short of it, and then running back into the range. So we could be looking to trade as long. We have also put in a 15-second intermediate term high, which would line up or a second stage short potential entry. So I'm just keeping a close eye out of that and got my finger on the flatten button in case we need it. At 6:48, we just worked below that 15-second impulse low, closed back above in the 1 minute. Now it's at 16:49. As we approach the 1900 hour as well, the fact that we've only been moving in one direction since the open is kind of a bit dodgy as well. There we go, getting a bit of volatility at 16:49. Going to get a new 5-minute candle in a minute. Cool, that might be a place to exit right here. So it did get a 15-second close back low that's low, and sure enough, that just started dropping. So getting out of the position at the moment. Cool, and I'm flat. So that ended up being plus $4.30 or so. And I'm anticipating that will likely sell off right now. So yeah, feel like I traded that pretty well. Held on to the trade as required and was able to watch how much price strength or weakness price had as it moved towards my targets. I had those points of interest in mind where I wanted to see price get through. And when we were rejected from that consolidation high again, that gave me a warning sign. I then identified first stage on the 15-second chart, second stage as well, which did have a movement right to where my stop would have been. I've just got a new 5-minute candle opening and it works down instantly. It's now ripping up a little bit. But yeah, it's not really the trade I was after just now. And it came all the way back down to the area where I saw that as being trapped traders while respecting 5-minute SIBI after having taken multiple 5-minute candle highs. Yeah, so I'm going to leave that for now. If we get down, super out the lows again, that 15-minute wick low, without closing below the BPR MT, and then close back above the midpoint of the 15-minute wick, that would constitute a triple wick flip long entry. If not, then potentially get long down at around 3,993 or so. And if it does just rip from here, however, then I will simply leave it for now because we're getting too close to 1900 and we haven't taken any sell side just yet on this day. So that doesn't fit my my trading model. I need to see us have taken sell side after 7 p.m. After 7 p.m. or opposing liquidity because I was burnt on that a few times just last week. So something that I'm observing and I think it will serve me a lot over the long term. Okay, quick update. It is 16:58. We actually got some really interesting price action just after I turned off the recording. What happened is we had that new 5-minute candle open, which aligned with that 15-second second stage, which is where I manually exited. And then we wicked down aggressively. And then that 5-minute candle, that was in the first minute of the candle, created that wick, and then gapped up and with a little volume imbalance into 1851, rallied up. And then we got a closed bullish above that 5-minute SIBI, looking really strong. We then had at 1853, we had a down closing candle that dropped back below that 15-second impulse low. And then the very next candle rallied back up and closed above that with a 1-minute CSD. So it's looking really strong at that point. It looked at the 15-second charts. We had a impulse rejection failure above that 15-second impulse high from first stage. That's aligning with that first stage. And then we ripped after that. So now we are actually aggressively moving higher at 1859. I bought on that 1-minute thing. Getting a real nice rally right now. So I've just got my stop loss below the first value gap that I require to be a breakaway. And then we've got 1900 opening up right now. So I want to see if they can reach up at least to 15.10. I've got an old short-term high just there. But yeah, anticipating that should keep pushing. We want to catch that new hourly candle volatility, especially since we only started climbing out of this range at the end of the hour. So it was looking bearish and kind of like a little bit toppy that entire time. So now that it's pushing higher, I want to see continuation. But yeah, so that's the intro was based off the 15-second impulse rejection failure, as well as the fact that initial candle created we had a nice last second wick as well. So getting a really nice push at the moment and just monitoring price. And I'll be doing that 2-minute trailing stop for risk management at this point. And if we get a really big pump as well, that looks like it might want to slow down a bit, then I'll perfectly happily exit as that will do. Beautiful. It's just got a really nice pump from 1900 and then 1901 running up into a premium SIBI, and I closed out up there for a really nice little trade. So that trade was $11.43 with, I think it was less than $2 risk, so about 5R from that. What was so nice about it was just the fact that we had we had failed to take out a 1-minute impulse high. So we'd souped out the 15 minutes long wick low, spent time down there, and then started rallying high. So I was pretty confident that we'd hit a 1-minute impulse high, but we didn't. That kind of threw me off a bit. We then got that 15-second market maker buy model forming, but at the time I didn't really know what it was. I just saw the first stage of the model, and then I saw second stage forming, recognized the entry for second stage, got out just before that second stage played out, which was just a really little spike on the 1-minute chart, and then that reversed straight back up, broke that intermediate term high from first stage of the 15 second time frame. and rejected low aggressively. But then as soon as it rejected low, it rallied straight back up, closed back above that 15-second impulse high with a 1 minute CSD, offering a 15-second impulse rejection failure entry, as well as that 1 minute order flow confirming, the 5 minute order flow also confirming. We had a long wick above us in 5 minutes. We hadn't taken any buy sides and selling off like that, and closing with that big 5 minute down closing candle. So all those things together really aligned nicely to make it quite a nice trade. And I just recognized that, like everything was in alignment. I was able to take that entry. The reason I didn't size into it with more than one lot, or one position size, which is 0.01 in this particular account, is because of the fact we were nearing 1900. And as I mentioned earlier, I don't want to be taking trades opposing. When we haven't taken opposing liquidity, I ideally don't want to be jumping into trades at that point. So I was looking to see if we could, I was just a little bit more cautious than if it had been 5-10 minutes prior. But yeah, that worked out beautifully. I'm now looking to see if we can rip up to that 1 hour candle high. That's my ultimate target. Because I'm out of it on my personal accounts now, not too worried. I do have a demo account running still. Just took a partial up at 4,015 and now got stop at break even. Look at that run up into the high. If we do sell off from here, I won't be taking that long entry from low down anymore, and that's simply because I've done perfectly well today, up $30 on the day, and that's on an account that was at $48 on Friday. So there's no need to be putting on more trades today at all. That is a very nice return for one day. It's like a 60% return. I'll just leave that one as is.